There, this is Keith Neely.
Hold on, hold on. Give it a
Okay.
second. It's going to take it takes a minute for it to go
Okay,
up.
excellent. All right, cool. How'd you like the energy though?
I loved it.
Cut.
Okay. We are live.
Hi, this is Keith Neely with the Licata Group. Welcome to our Tuesday LicataLive. I know we're normally at 11, but tonight we're at a special time at 6 o'clock. Back by popular demand, Mary hosted this credit workshop. It was very popular. People loved it. So the information's great. So we want to do it again. We have Jordan Goldberg with Credit Plus. He's going to tell us how to get your money right. And then we're going to talk with Stacey Barrowich, and she will tell us a few things about what it takes to get your first home. So enough with me. Jordan, take it away. Hey, one other thing, sorry, real quick. If you have any questions, type of questions in the comment box and we will get them answered for you. Okay, go ahead, Jordan.
Hey, thanks, Keith. Appreciate it. Glad to be back here in front of everyone. And, hopefully we've got some repeat folks out there today. Maybe your questions weren't answered last time, but as Keith said, we're here to help. We're going to talk about credit reports, credit scores, just really how to, get your credit in order so that when you're applying for that mortgage with Stacey at Movement, it'll be smooth sailing. I've been in this industry for, holy cow, almost 30 years, tons of experience, love helping people with understanding credit and their credit scores, and making sure that not only do they qualify for a mortgage, but they get the best mortgage possible. Maybe get the there's all types of different loan programs out there, and Stacey's going to talk to you about that. But I want to make sure that you have maximum credit scores. And just so you know, I'm not a credit repair guy. I'm not going to sit here and talk to you about, hey, send me money and we're going to make all your credit problems go away. That's not what this is about tonight. We're going to talk about, smart credit decisions, how to make sure that you're doing the right moves so you will qualify for the lowest interest rate and the best mortgage. Some of the things that we get asked about a lot are, why is my credit score different, or what's going on with that, right? There's lots of different sources for credit scores out there. When Stacey at Movement pulls credit on you, she has a specific credit score for the mortgage industry. It's an old, outdated version of the credit score. It actually came out in 2004, so it's 18 years old this year. But you may be someone, like me, that goes to Credit Karma and has an account. Or, if you look at your Capital One or Discover credit card, they're going to tell you, hey, look at CreditWise. Here's your credit score. And these are all different scores for different purposes. If you go to buy a car, if you apply for a credit card, right, it's a different score model. So for tonight and for someone that wants to get a mortgage, it's all about the mortgage score that Stacey sees. So don't be confused. These scores look at stuff differently. They treat stuff differently. Some of the biggest things that impact the score are paying bills on time, keeping your balances low on your credit cards. That's huge. But, something else that impacts our score is collection accounts. And when you look back at those different types of credit scores, like even if you're on Credit Karma, just know that the score that you see on Credit Karma ignores a paid collection account. That's huge, right? Because if you have paid collections, and on Credit Karma, it says your score is 700. If Stacey pulls your credit, she may see a much lower score. She may see a 600 because the mortgage credit score counts those collections against you. If it's paid or not paid, medical or non-medical, the mortgage score will count that against you. The credit score, looks at a lot of different factors, but we kind of break it down into 5 main categories. The most important is payment history. Pay your bills on time. It's okay if you pay late by 1 day or 10 days. Your creditor may charge you a late payment fee, but it won't hurt your credit score unless you pay 30 days or more late. That's when it gets dangerous. So always try to pay around or before that due date. And again, if it slips past the due date by a day or two, don't worry about it. You always want to make sure that they received your payment. Sometimes they'll miss your payment and you go 30 days and you're not even aware of it, and that'll hurt your credit score. The second most important factor is balances on accounts. And credit cards are more important than an auto loan, right? If we come to an auto loan, a mortgage, a student loan, we call that installment debt. And we mainly look at, do you make that payment on time? Credit cards carry more weight. The balance on a credit card actually is 30% of your credit score. And we always want to look at that. We add up, the credit limit you have for all your credit cards, and then we look at the balances, and we call that a utilization ratio. So the balance in relation to your credit limit, you want to keep that as low as possible. Really the area you want to focus on is your balance higher than 50% or lower than 50% of your credit limit? We really want you to be below 50%. That's good, but we want you to get it even lower, to drive your scores higher. If you can get that balance below 25% of your credit limit, yeah, that's good. That's great. But really for maximum credit scores, you want the balance on your credit card to be below 10% of your credit limit, right? That can be tough for people, right? Some people carry credit card debt and they have high balances on their credit cards. Well, we have to look at them and we have to figure out how can we reduce the balance on that credit card to lower your ratio and drive your credit score up. And Stacy knows all kinds of ways to handle that and strategies for that. Other pieces of the credit score, you'll notice if you flip back just one, Stacy, is we don't talk about inquiries, right? You don't see inquiries showing up there. New credit counts for 10% of your credit score, and that's where inquiries come into play. It's a portion of that piece of the pie. So don't be afraid to have your credit pooled, and we'll even talk about what happens when Stacy pulls your credit a little bit later. We talk about always making your payments on time. If nothing else, make that minimum payment. If you have a Kohl's credit card, a Home Depot card, a Best Buy credit card, set up online banking to pay the minimum payment, before the due date. Or you could drive by the store on your way home from work or when you're running errands and make a payment at the store. Always make sure you're at least paying that minimum payment, but we'd like you to pay more than the minimum. Really, ultimately, my strategy is to get everybody to pay the full balance off on a credit card every month. Utilization ratio, we talked about that. The lower the ratio, the better. You got to keep that down. A lot of people think that they have zero balances on their credit cards. They don't use them, and they think that's good for their credit score. But actually, if you have all zero balances on your credit cards, you would actually have a higher credit score if you showed a low balance on just one credit card, right? And I'm not telling you that you have to charge $500 on a credit card and then pay the balance down to $100 and pay interest on that balance. That's not what you have to do. Use the credit reporting cycle to your advantage. Pretty much all credit card companies report to the credit bureaus once a month. And usually it's around the time that they generate our monthly statement. So if you have a credit card with a $1,000 limit and you charge $50 on that or $100, right, you're at 5% or 10% utilization ratio on that card. Now what you want to do is get the statement from that company and then make the payment before the due date. And that company will actually send the information to the bureau saying that your balance is $50 or $100. You can pay it off, get it to zero, don't pay interest, and repeat that cycle every month. That drives your credit score up. And the easiest thing to do is this, what we show on the slide is use your credit cards to pay the bills that you pay every month, right? We all have these cell phones, right? We have cell phones, we have gym memberships, we have utilities. Set it up to pay those payments on a credit card, get the statement, pay the full balance before the due date, drive your credit score up. Right? A lot of people ask about, applying for credit, does it hurt? All right, and this is what I mentioned earlier, right? Having your credit pooled creates a hard inquiry, right? If you're applying to get a credit card or a loan or some type of financial transaction, it's a hard pool. There are different types of pools out there called soft pools. Like if you went to Equifax and asked for a copy of your credit report directly from them, that's consumer credit, and it's a soft pool, so it doesn't factor into your credit score or credit score. But if Stacy pulls your credit, another mortgage company pulls your credit, right? If you apply for an auto loan, you go to a few different dealerships, right? Don't worry about having your credit pulled multiple times for the same transaction, right? We have rules in place to protect your credit score, but we want you to keep it in a short period of time, right? So let's say you talked to another mortgage company last week, and now today you talk to Stacy at Movement, and she pulls your credit. right? Two companies have pulled your credit for a mortgage in 1 week. It counts as one inquiry. It doesn't count as two, right? Because we allow for a 30-day time period, and you can have multiple inquiries in that 30-day time period, and it won't hurt your score. But it only applies to mortgages, auto finance, and student loans. So if you go to the mall and you apply for a credit card at every store in the mall, well, each one of those inquiries is going to count against you. We can all get free copies of our credit report. There's an awesome website called annualcreditreport.com. You can get a free copy from all three bureaus once a year. So that's something I highly recommend that you do. There's another website out there called myfico.com, and you can go there, and it's a great source because you can see your FICO score. You have to pay for it. It's not free, but you can see what your mortgage score is, your auto finance, your credit card score. They break it down into different categories. So it's a helpful tool, but you do have to pay for it. Again, here we say 45-day window for shopping in a mortgage, multiple credit checks. You'll always see information out there. It could range from 15 days to 45 days, but we always recommend you keep your shopping within 30 days. How do you fix your credit if you have something negative on it, right? I mean, that's just something, life events happen. You could have an accident, you could lose a job, all kinds of things happen, and, it could impact your credit. But what do you do? Well, the most important thing is to talk to your creditors, talk to the companies, make them aware. Don't just ignore them, right? That's the worst thing to do. Sometimes if you call a company and say, hey, look, I had an accident and I can't make the payment right now, but I can pay you next week. Then they'll say, you know what? Okay, we'll give you a break. We'll forgive you. Maybe we won't report you as late. Always communicate with them. But if you ignore it and the damage is reported and it shows on your credit report, it could stay on there for 7 to 10 years. That's a long, long time. It'll impact your credit and your credit scores and your ability to get credit. A lot of people don't realize this, but if you pay late, one 30-day late payment on an auto loan or a credit card can drop your credit score about 50 to 100 points, right? That's a huge, huge deal. So, pay your bills on time, address, speak to your creditors if you run, if you have a life event that causes negative impacts on your credit. Some other things you can do is reach out to collection companies, and there's a process we call pay for deletion, right? If you have a medical collection, or maybe you had a cell phone that you didn't pay the bill and it went to collections, you can always call the collection company and negotiate with them and say, hey, you know what? I owe you $100. If I pay you, will you delete it from my credit report? A lot of collection companies will agree to do that if you ask. Sometimes they'll say, no, we can't do that. And they don't have to agree to do that. But a lot of times, if you speak to them calmly, don't get into an argument with them, just say, hey, here's the situation. Here's what happened. I had COVID, I was overseas, I was in the military, something like that. Try to get them sympathetic to your cause, and then work a deal out with them where they'll delete it from your credit report. And if they agree to delete it, poof, it's gone. It's like it never happened. A $50 medical collection that shows up on your credit report will drop your score 100 points. That's huge, right? You could go from 700 to 600 overnight, and that makes a huge difference in getting a mortgage, right? Any questions out there? Anybody asking any questions, Keith?
Yeah, we have one question. It says, will poor credit result in them paying higher interest rates?
Absolutely, it can. It really depends, and Stacy can talk about this. Depending on the loan program, right? Some loan programs, the rate is the rate, if you qualify for it, but Stacy can talk about that a little bit.
It just depends on the program, Keith. And it depends on what type of credit score is. Every loan, depending on what it is, they call a loan level pricing adjuster. So that, depending on what your credit score, will affect the interest rate given. The higher the credit score, the better the interest rate.
Okay.
And then from other areas, just so you know, if it was an auto loan or, a credit card, if you have poor credit, you can qualify, but yeah, a lot of times you end up paying a higher interest rate. And, for some folks, that's just the only credit available. That's the only option available. But I always tell people that, poor credit, versus good credit versus excellent credit, it's just a matter of time if you make the right moves. You could have a credit score in the low to mid 500s, and maybe you had collection accounts, late pays, balances on credit cards, right? The easiest thing to do is pay down the balances on the credit cards, then try to get some of the collection accounts deleted by negotiating with them, pay for deletion. Late payments are a little bit harder. Time may be the only thing that helps improve scores if you have late payments. But I see people go from a 550 credit score to a 640 or higher credit score in 3 to 6 months time. And then there'll be a 700 credit score, in a year or two. So it's really just a snapshot in time. And if you follow the right moves, take the right action, you can improve quickly. On the slide right now, we're talking about if you have no credit, what can you do? All right, because it takes credit to get credit. And just so you know, if you're some of the younger folks on this call, you have to be 18 to get your own credit card. If you're younger than that, or if you're just starting out and don't have any credit, you can see if somebody, a friend, a relative, a parent will add you to their credit card as an authorized user. Right? I do that in my house for my children. I've made them authorized users on my credit cards. Those accounts report on my kids' credit. All right. It looks like they have their own credit card, even though they're not responsible for it. So I make the payments on time. I keep a low balance on that. So it gives them good, positive credit. Another thing you can do is apply for what we call a secured credit card. That's, there's a website out there you can write down called Nerd Wallet, nerdwallet.com. And you could search for secured credit cards and they'll let you know the best types of secured credit cards out there. But basically what you would do is you would send that company or that bank, you deposit $300 with them. They would put that in a savings account for you. And then they would give you a credit card with a $300 limit. And you could use it like a normal credit card, but if you don't pay them or make the payment, they have your money in the bank account that they could use to cover the balance. And that will, you always want to look for companies that say they will report to all three bureaus. That's the main thing with secured credit cards. After that, you'll establish some credit. Then you could probably get, a department store credit card, like Kohl's, or other types of retail credit cards out there. They don't have strict requirements for their credit cards. Keep making all your payments on time. Try to keep low balances on the credit cards. Maybe at this point you have an auto loan or some other type of loan. And then after that, you can, get a bank credit card. Those are, where you can apply with Citibank, Chase Bank, American Express, where they have tougher requirements. All right, next one. All right, and then that's pretty much it. What we have. Any questions left for me? Anything out there? I think you're muted. Sorry, Keith.
Am I muted?
No, Keith was muted.
Sorry.
Hi, I'm sorry about that. No, I don't think we have any more questions. That was some great stuff, Jordan. That was fantastic.
No, I'm glad to help out. Always appreciate getting in front of everyone. Thank you very much.
Jordan, you're awesome. The information you provide is really good. We appreciate it.
Absolutely.
And I'm just going to run through. Go ahead, Keith.
No, go ahead. No.
I'm just going to run through some first-time homebuyer programs and the credit score requirements for them. So we can kind of just go from there. So you can see what you can. There are 5 types of loans here. We've got your FHA, which is the Federal Housing Authority government loan, VA, which is a Veterans Administration, USDA, which is a rural housing development for those in the outliers in certain counties like Orange County, Culpeper, parts of Fauquier, Fauquier out that way. And then there's VHDA, which is really now the Virginia Housing Authority. And then we have, your conventional lending, which is, 80% of what loans are made up of today. So we have all these different loan programs. The first one is from the FHA, which we just talked about, which is a government-backed loan program with a low down payment. The down payment required is about 3.5% of the purchase price. although most of the FHA loans are first-time home buyers, they're not required just for first-time home buyers. This is for primary residency only, means that you have to occupy the property. Non-occupant co-borrowers are allowed, and what that means is if you're just out of college or you're just starting out and you need someone to help you qualify for the home, and you've got a parent or close relative willing to co-sign for you, they allow that. Although FHA allows for lower scores, our criteria is a 580. That's the most that as low as we go down to. So if you have a 580, you could qualify for a home purchase with 3.5%. Minimum qualifying standards are 2 years post bankruptcy and 3 years post foreclosure. So if you've had a hiccup in the past, this is a great loan program that can kind of get you into a house again after 2 years for a BK and 3 years from post closure or short sale. VA loan is you have to have served in the military, and then you've had to serve a minimum of 101 days during peacetime and 90 days during wartime. National Guard reservists who have served at least 6 continuous years with honorable discharge are eligible to use their VA. Unmarried surviving spouses of military who have died during service or by result of disability caused by service. Spouses of POWs and MIAs. Primary residents only. They don't do any investor or second homes. It's got to be where you're going to live. 580 is the minimum credit score. And on this particular loan, there's no down payment required. So that's a really great opportunity. USDA loans was what we kind of briefly talked about. These are financing government-backed loans for rural development areas, which also allows for 100% financing. They are primary residents only. The borrower cannot own any other home at the time and cannot exceed household income limits. They've got a pretty strict household income limit. They're definitely not limited to first-time home buyers. The property must be located in a rural area, and there's this website there that you can go in and type in an address, and it'll tell you if that property is eligible for a USDA loan. They also have a minimum FICO score of 580, and again, they don't require a down payment. And then Virginia Housing, which also provides down payment assistance and grants towards people that are qualified. They are for first-time home buyers. They're for someone who's not owned and occupied a home in the last 3 years, primary residents only. And they actually, with their program is that they offer FHA, VA, USDA, and conventional lending, but they give you the down payment or closing costs, depending on the loan type, to help you get to the settlement. And they have a 620 credit score requirement, and they do have income restrictions and household income restrictions on that. So if we ever get to that point, we can actually look through that. The next one is, we've got, I know everybody's heard about this, Fannie Mae and Freddie Mac. They're the ones that have the majority of the mortgages out there. Fannie Mae and Freddie Mac, and they're your regular conventional lending. They also have, any buyer can use a conventional loan as they meet the guidelines. First-time home buyers down payment requirement is 3%. And you can go up to anything after that, 3 to 20 to 25 to 50% if you want, if you've got the funds. Credit score is 620. Prior bankruptcy, you have to wait 24 months from the discharge date. And then if you've got Chapter 7, it's 2 years. Previous foreclosures must wait 7 years. And if anybody doesn't understand, previous deed in lieu of foreclosure, sale or a short sale, you have to wait 4 to 7 years from the time that it is recorded. So if you had a bankruptcy or a short sale and everything, it's when it actually transfers ownership. So when it comes out of your name. And so you've got that. And those keys are pretty much the basic information on lending. Those are just, if anybody's interested in getting more information, please reach out to Keith. He'll get you in touch with me.
Absolutely.
Actually get you some information.
Sounds great. Hey, I do have a couple questions for you. That came in. Now, this one, I think I know what you're going to say, but I want you to say it.
Okay.
What is the best loan for a first-time home buyer?
Oh, well, it really depends on your financial situation.
That's exactly what I thought you were going to say.
Yeah,
It
really depends. I mean, your credit score has a lot of impact in it. It depends on how much money you have saved or not saved. It depends on what area you're looking in. And there's multiple different ways. And I think that if you can kind of narrow down where you're looking to live, then we can look at the programs available for that area.
Awesome, awesome. And then I have one, but pretty long, so bear with me.
Okay.
Is there any way that, I'm asking for a friend, is there any
Okay.
way that I could get a loan started on an LLC that started just a year ago? The previous job doesn't necessarily show 2 years of having regular employment. So he has an LLC for a year before that, it's not 2 consecutive years with an employer. Is that?
Okay. Let me start with this. Most conventional lending, and I'm talking about all the programs I just talked about, will not let you close in an LLC and for the most part, we do not let you close in an LLC because everybody, I don't know if anybody was around when the .com or the housing bubble went in 2009 and 10. There were a lot of loans that were done in an LLC, which no one was really held accountable for them. So when the homes went to short sale or foreclosure, the banks really didn't have anybody to be held accountable for that particular loan. So in most cases, your average lending is not going to lend in an LLC. We do have some non-agency, which is kind of considered nothing that's in that realm. It's called non-agency. And they do have some programs for that, but they do want to see at least 2 years tax returns in the LLC. If you want to do it, you can always buy a house in your name. And then when you qualify down the road, maybe put the title in an LLC, but for the now, they don't want you to put the mortgage in the LLC, at least where we're at. They do allow it in other non-agency things. So you're going to get different interest rate, different criterias and things like that.
Wow. So it really is individualized to everybody's case. Is totally
different. And to believe it or not, it's the type of home you buy too will determine some type the interest rate. I mean, there's nothing wrong with condominiums, but unfortunately they have a slightly higher interest rate than a regular conventional house, single built, standalone detached. So yeah, everything has, it all narrows down to the person, the type of loan and where you're going to buy it.
Awesome. Awesome. Any more questions, Jasmine?
I have one, Stacy.
we have
Go
one.
ahead.
I was just curious, is the information you provided for Virginia, or is this kind of like nationwide in the States? Or
I will say everything with the exception of the VHDA loan. So FHA, VA, USDA, and conventional is applicable across the country. The only one that is different is the state program, which is VHDA. And every state primarily has a first-time home buyer program. So Maryland has MMP, DC has DC Open Doors, Virginia has VHDA. You know, depending on what state you're in, they have, for the majority, they have their own housing programs.
Awesome.
Great.
Awesome. Any other questions? I think that wraps it up. Stacy, this is wonderful. Thank you very, very much. And I don't know if Jordan is still on here or not, but the information was fantastic.
Great. Well, if there's anything we need, Keith, thanks for having us.
How do I get a hold of you? How do people get a hold of you if they want to?
Well, they call you.
Okay, that's a good answer.
They call you, and then you can call me.
Absolutely. That's
All right.
sounds like a plan.
All right.
Excellent. Well, thanks a lot, Stacy.
Thank you. See you guys later.
Adios.